Most clients, particularly on the institutional side, are very well invested, let's call it, in US dollar assets. And there is a lot of interest for many reasons, including policy in the US, for diversification of dollar assets, right? So where do these non-dollar assets go? If you kind of look around the world for cheap assets, small companies definitely speak out.
Die Geldmeisterin. Der Finanzpodcast mit Julia Kistner. Hello, Michael Oliveros. Nice to have you here on Podcast Geldmeisterin.
Thank you for having me. Happy to be here.
And you have a really interesting topic, the small cap. What fascinates you, first of all, about small cap stocks, and what do you consider as a small cap?
Fine. Yeah, let's start there. Different regions, different people have different understandings, but just to set the baseline, in our investment strategies, we define small caps as sub 10 billion US dollars in market cap. If you're in the US, Americans will tell you that 30 billion is a small cap, but for our purposes and global perspective, we think at 10 billion. What fascinates me about small caps, I'll answer this two ways. Part of it is my background. I have been interested in business and entrepreneurships as far back as I can remember. When I was a little kid, coming up with schemes to make money and to just, be a business person. My first idea for a business actually came to me in high school. It was a business that we were looking to effectively rent out exam questions to students during finals preparations because we saw the need for ourselves. The first business I ran actually was a college painting business in my first year at university. And it's been a thing for me since forever. My early career was consulting with family-owned businesses and then M&A consulting, and then kind of ended up in this position, which we can talk about later. So it's partly just my let's call it predisposition and who I am, but a lot of it had to do with just the opportunity that is presented in small caps. And this really started in 2015 when I decided that I would take over the Pan-European small cap fund at M&G. I was running global all cap at the time, and I came across a white paper and a thought experiment. The white paper was called International Diversification with Large and Small Cap Stocks, which basically talked about the benefit of smaller companies for generating better risk-adjusted returns in a total portfolio. And we'll go on to talk about that later. So that was just sort of an observation that these things act differently and can have a benefit. The other was just the thought experiment. And at the time, and it still is a thing now, there was a lot of question about the role of active management. What can an active manager do? And I had come across this thing called free chess, which I'm not sure if you know about, but the story of Garry Kasparov is pretty famous. He loses chess to Deep Blue. People sort of lose touch with what happened after. What happened after was he became a proponent of people, let's call it AI or computer adjusted or assisted chess playing. And what they learned was that, yes, a computer can beat any individual, but a person with a computer can beat a computer. Mm-hmm. And it was specifically around what is it that's good? What is a person good for? And it sort of led me down this path. And I said, okay, so what are computers not good at? They're not good when they're short sample or a limited data set. And that's kind of what you're talking about in small cap space. You have undercovered assets, some of them with very short track records, some of them with track records that have been in and out of the public markets. And that creates just difficult scenarios for computers or other investors to invest. And I look at that and I say that creates a level playing field for me, because I'm not any more disadvantaged than anyone else to apply what I do. And I think with the right discipline and process, that creates some opportunities to create alpha. So that's a long story. Part of it is my background and really just the opportunity that I see.
Okay. So the background, I can understand. It's really entrepreneurship. It's really very nice to be in this field. And also I can understand that it's good for diversification in the portfolio. And third, it is that the less of transparency you have in small cap, because if you compare it with the larger ones, there's the opportunity for the human being, which the KI cannot get so easily. And then as far as earnings is concerned, it seems to be never-ending narrative that small caps could outperform large cap. I just looked at S&P 600 and also at FTSE 250 year to date. And I guess you have a slightly different opinion on small caps, but I can't see really the opportunities as far as the earning is concerned.
Sure. So maybe if we take that back. So is the question, what is the opportunity given that things have been difficult? Yeah. So that is undisputed. If you are looking at the data, if you are looking at the performance, all you have to do is look at a stock chart, and it's been not great to be invested in small caps. And you could pretty much say that since 2018. There was this brief burst sort of post reopening in 2020 when small caps did really, really well on reopening. And then the big tech giants sort of took over again from 21 onward. I think, it's important to sort of put that into context. So you would have said the same between 94 and 99. You would have said the same from 07 to 09. And you would have said to me, and I remember because I was at Credit Suisse during 94, 95, 96. And the question then was like this next nifty 50. And it was like big caps. Do you remember? So I see you remember. And then something happened in 99. And then small caps outperformed from 98 roughly to 2008. And then 07 to 09, they underperformed. And then they outperformed 09 to 2019. So I think there's really two questions you need to ask when you look at the current period of underperformance. You have to ask whether or not the underlying factors that contributed to the underperformance today are any different than they were from 94 to 99 or 07 to 09. Number one. Number two, you have to ask, has anything changed in terms of the underlying factors that contributed to the subsequent outperformance? So let me start there. So when you look at 94 to 99, you look at 07 to 09, and what I would contend you see from 18 roughly till 25 is the same underlying factors at its core. And then some other things happened around that. But you have an overheating economy that leads to inflation. You have central banks raising rates to slow down overheating economies. And then you have, number three, success of those underlying policies, which is a recession, or really in our world, destocking. So let's take them as inflation, rising rates, and then slowing economy. If you look at the structure of small caps versus large, those three things will disproportionately impact smaller companies. Let's just take inflation. So smaller companies typically have less immediate pricing power than large. When I say immediate, I mean the ability to pass through one-to-one euro of inflation to a euro of sales in the quarter or in the month. So what happens in the real world? If you are an auto supplier to Volkswagen, you will get an annual, maybe semi-annual repricing event. And so once a year, maybe twice a year, you can readjust your price. Volkswagen can raise prices to the consumer tomorrow, right? They're unconstrained as it relates to the price of, a Passat or whatever on the lot, because they have the ability to determine what the price is. So that's just simply to say that it takes more time for smaller companies to push them through. And they tend to be a bit more people intensive. So typically you feel the effects more. Rates, small companies can't issue 100-year bonds at negative interest rates. Right? They have to go to the bank, and the bank will price you LIBOR plus. And so when your 10-year, rate goes up 500 basis points, you take that on the chin right away. And it takes time to reprice or pay down your debt. And then because you typically are sitting upstream in the case of our auto parts supplier, as you sit upstream in the production plan, what happens is Volkswagen says, you know what, don't send me those brake pads. I want you to sit on them, right? And so now you're sitting on these brake pads and they show up on your balance sheet as inventory, and it slows down your business. And so I mention this because what's happening is your margin is falling. Your balance sheet is becoming more constrained because of interest rates, because your earnings are going to bondholders as opposed to the equity holders, and you're not converting inventory to cash. So what you said is exactly right. Your earnings profile is not as attractive. But then guess what happens when you cut rates, right? It all goes in reverse. And there's a term for this. It's called the bullwhip effect. What happens is that the upstream suppliers will tend to feel the negative consequences of these economic declines first, but then the opposite happens, and it tends to be of equal and opposite magnitude. And I can send you the data. It is very well corroborated in the fundamental data as well as the price data. So those are the underlying factors. I guess the question that you have to ask is, are they any different? And my answer to you is they're not. What is different is that the stocking effect is much more magnified because of a thing that we all know but forgot, which is COVID, right? So did you order a desk or a computer during COVID by chance? You had one?
No, I had everything.
Okay, no furniture, nothing. Okay, fine. This is not going to work. But I can tell you, yeah, I can promise you somebody listening has felt this. They probably ordered a laptop. I did. And it was a 6-month waiting period, right? And the reason it was a 6-month waiting period is because it was sitting in the port of Shanghai because of lockdown. And so what ends up happening is in that period, in order to get orders, people over-ordered inventory because they weren't sure when the goods would arrive. And then what happened was by the time they arrived, everybody could start to go out and then didn't want the goods anymore, right? So what ended up happening was the normal destocking cycle, I can tell you this from fact, only really ended at the towards the end of last year. So it was sort of like a 4-year destocking cycle. And then this was the year that you were meant to see reacceleration of demand, but as you know, something happened in April, right? That had an effect on the demand side. But the point is the underlying sort of stressors that cause the underperformance are now past. And really what you need is you need the demand cycle to return. If that were to happen, my sort of observation in terms of the companies we speak to and my understanding of what's happened in the past is that there's no reason to expect the outcome to be any different, unless you sort of say that the market just doesn't care. But I think value is going to dominate in the end and the cash flows will win. So quite confident that things haven't changed, but we'll see. I could be wrong. We can see. But I can say that with confidence, the underlying factors are in place. And there's a very strong historical precedent for how stocks will react after, which we can talk about if you like. But the short answer is you don't want to miss it when the market returns because it comes quick and it comes aggressively.
And do you think you have then really good opportunities for the small caps right now in Germany?
Yes, absolutely. I think, and I'll give you 3 reasons. One is just simply the residual of what you said. So the underperformance, to the extent that the underlying cash flow potential of the business has not changed materially, just means that they got cheaper, right? So if your underlying earnings power are relatively constant, and they are for the bulk of very high quality businesses in Europe, in particular, Asia to a large extent, Latin America for sure, because I was just at a conference. We can talk about LATAM as well. So when you look at that cohort of very good businesses, the fundamentals haven't shifted. In fact, they probably got better. I mean, I'll tell you why in a second. If the price is falling, it just means that there's more value on offer. So that's number one. And I told you all the reasons why you can see that to mean revert. And I think there's a question maybe later about where the value is. I'll leave that to a second. The second we talked about is diversification. And that's becoming increasingly important with the clients I speak to. Most clients, particularly on the institutional side, are very well invested, let's call it, in US dollar assets. And there is a lot of interest for many reasons, including policy in the US, for diversification of dollar assets, right? So where do these non-dollar assets go? If you kind of look around the world for cheap assets, small companies definitely speak out. So that's a big thing now with diversification. The third thing that I would say, and this is important, is that why did people want to de-dollarize? It's because of policy choices that are being made, not just at central banks, but at governments. And if you look at that, what's really happening at the company level, and I can tell you from personal experience, is that the economic playing field is changing in ways that level that for smaller companies. So it used to be the case, I'll make it specific. It used to be the case that an American company could set up a plant in China and then export to the whole world and then reap the benefits of massive global economies of scale with a very cheap labor force. You can't do that anymore. You have to have a plant in Europe supplying to Europe because the EU is saying so. You have to plant in US, not Mexico, in the US to supply to Americans. Asia supplies to Asia. And if your business was built on one factory for global scale, it doesn't work. The opposite is true now for small European companies, say. We're seeing small European companies that no longer have, or who can no longer, we'll say, the US customer can no longer buy from China. So now the pricing power of that European company exporting to the US has just gone up. They can extract margins that they hadn't in the past. So the global playing field for smaller companies is more level relative to large companies and more level relative to global peers and global competitors in a way that's very different. And that's very interesting to me. And I see it day in, day out at the company level. So that one's a big thing. And then I'm not even going to touch the small cap premium because that does exist. But if you take those 4 factors and you take what I just said, that it's an asset class people aren't looking at, and it's a very interesting time Very, very interesting.
This is really interesting. So you think that the economy of scale, the opportunity for the large companies is not that much anymore in comparison to the smaller companies?
It's not as obvious that you can use global scale to outcompete smaller companies. And I can tell you that because I have to be very careful in manufactured goods space.
Yeah.
In intellectual property, if we're talking about large language models or AI, scale on intangibles is different. But for companies that make things, it's not the same. It's actually a disadvantage to have a plant in China. You now have to build 4 plants, which is automatically not as good. So what are they doing in practice? They're sourcing from smaller companies that are already in situ.
So where you select the jewels under the small caps, is it in the manufacturing area then where you have especially interesting opportunities?
Yes, services as well, but I will keep it very simple. If we are I'm going to take something that everyone take for granted at the moment. Let's talk about artificial intelligence, right? A lot of excitement about the number of hundreds of billions or trillions of dollars, depending on who you count up and whatever, for CapEx in the US. Or let's take in more close to home for us. Like if we look at defense spending, right? In order to build the number of data centers that people are talking about in the US, which requires a whole lot of energy infrastructure, or the amount of defense equipment that is discussed in the European context, requires an entire redo, upscaling of the entire supply chain, right? And that goes everything from power, transmission, and distribution to literally, do you have enough capacity to make the nuts and bolts and screws that go into the tanks? And the PCB boards that will go onto the electronic equipment. It's an order of magnitude difference in terms of the scale relative to the things that were made in the past. And so the areas that I find the most interesting right now, people are very quick to jump onto Rheinmetall and the number of tanks they're going to make or whatever, which is true. But if you take a step back and you go, wait, for the number of power converters you need on the battlefield, you're going to need a lot of like inversion technology and uninterrupted power supplies. So we've been going through sort of line item by line item through the supply chain just to find, and there's some very fascinating European companies that are very cheap, that if you sort of extend the implied numbers in terms of what the market opportunity is. And some of these are dual use, by the way. They are currently going into a VW that people think isn't going to sell, but has another application in a different world. I think those situations are very interesting. So I would call them sort of like supply chain in the manufacturer space is in particular very interesting. And we see a lot of opportunity.
Can you define these opportunities a little bit?
You want some names? Am I allowed to go through names? I can give you the flavor of them and maybe a few examples because they cut through a few different spaces. So there's a company that we own called Sigmarock. People know it as a aggregates business in the UK. They used to make sort of gravel and sand and that kind of stuff. They've actually transitioned their business to be the largest manufacturer of limestone in Europe, right? So very quietly, they've accumulated assets in Germany and Finland and basically control everything around the Nordics through Germany, Belgium, in terms of production of limestone. If you don't know, maybe you can look it up. Limestone has been used, I think, as far back as the Egyptians for making the pyramids. Yeah. And it's used basically for everything from toothpaste to, this mug that I'm holding to, steel. Most people tend to look at it for construction purposes, but in really simple terms, if you're going to make the amount of capacity in Germany that people are talking about, you need a lot of investment in steel and you need a lot of investment in infrastructure and roads. The stock is single digit PE. People still think of it as a UK-based manufacturer for roads in the UK. That's like a tiny proportion of the business, right? The business is now a materials company that is very well supplied into this market, very underowned. It's the kind of thing that I'm talking about. So it's a business that is transitioned and is very much levered to things that people are, on the one hand, very willing to invest in, but on the other hand, don't look far enough down the supply chain to see the opportunity. So that's an interesting example. There are companies like Bufab in Sweden They do C parts, so nuts, bolts, and screws. Great business. If you're going to make a tank, you're going to need a lot of nuts, bolts, and screws. But even if you don't make the tank, the factory that will make the tank will need a lot of nuts, bolts, and screws, right? And so again, without having to take a lot of risk at the business model level, these things are very well geared to recovery. And there's another business called NCAB, which does the same, but for PCB boards. Like if you did a teardown of the next generation of tanks, the number of electronic components in that is some 10x historical version. So this just means that there's a lot of electronic components. And guess what? They have to be sourced in Europe. You can't take a Chinese part, right? Or a Taiwanese part, right? And so I think these kind of things, when you talk about an inflection on the demand side and a change in your competitor sets, set you up very well for, let's call it, earning in a different way than you might have historically. I could do this all day long, but I'll stop there. Yeah.
So at the end, how can you evaluate these small caps? Can you give me an idea, since there are less data and the cover is not there? How do you do it?
Yeah. The answer is the old-fashioned way. We need to do first-party due diligence. So we need to go into the field, see the business, meet the management teams, we speak with the customers, speak with the competitors. And really, there's two parts of the job. One is just understand the economics of the business and its ability to generate excess return on capital through time. And that's just good old-fashioned due diligence. And I would say that's no different than it was in the past, but the ability to generate alpha from that due diligence is significant in our world today, as of what I just told you. So we can do that. The trick is really two things. One, process, having a clearly defined approach and consistency so that my team can do that across the globe in a consistent way at scale. The second thing is portfolio construction, right? So if we do the job of building robust portfolios, it gets time on our side, right? Because if the portfolio is behaving, then we can spend time to find the next incremental good idea to get into the portfolio, to buy at the appropriate time to generate excess returns. So we have a heavy emphasis on both ends of the scale. I spend a lot of time making sure that the portfolio construction because the reality is this, you're one tweet away from volatility, right? Or one news release away from volatility. So you need to be on your toes and robust at the portfolio level. If you can do that, then it's just about working through the names. And I've been in this business now since 2011 on the buy side. I was on the sell side since 2004. In terms of the ability to find ideas everywhere, that's very different. It used to be the US kind of led everything, and then you would find the European version of something in the US or the Chinese. It was always like a play on something that was in the US. It's not like that anymore. There's each country, region, I should say, is interesting for its own region or own reason. And that is what I spoke about at the beginning. It's what's causing all of the need for geopolitics, geoeconomics. It's the reality is the world is bifurcating. It's splitting up. And that just means that Asia is doing its own thing. And Latin America is doing its own thing. And the US is trying to keep the world back under its umbrella and not really working. And then Europe is trying to build its own sort of presence. And that is a very interesting thing for diversification, as we discussed. But as a stock picker, it's very interesting because you find idiosyncratic drivers of value that they're fun, frankly, to analyze.
Okay. So to get to the end, I just get it that now you have really nice opportunities for two reasons, especially for diversification, and also since the world spreads apart, that their small caps have more opportunities than large cap in your opinion. Did I get it right? And at the end, where are the risks of small caps right now?
Yeah, I mean, these are the reality. Liquidity is always challenging, and that's actually worse than it was in the past, particularly as you get smaller into the spectrum. So liquidity is something you have to mind. If you need liquidity, you have to be diligent about how you build your portfolio in order to buy the stocks well, but also be able to trade out of them if you need or to take your money out. Volatility is very high at the stock level. We try to account for that at the portfolio construction level, but I don't view volatility as risk, but I mention it because depending on who you are, there is generally a preference for things that don't move around a lot. I look at volatility as opportunity personally, but I mention it. And then the last one, as much as it's as an as it is an opportunity and a value, diversification is also a risk. If the only thing that goes up in the world is NVIDIA, anything that is not NVIDIA is bad, right? in the short run. And so, it depends on your perspective and where you think the value is, But I think I want to be transparent about that, because at any given point in time, diversification might feel good or bad, depending on what it is that is going up at that moment. Over the long run, the answer is diversification is good, but you have to I'll be realistic and honest about it.
Okay. Then I say very much thank you that you get us some insights into the small cap world and also a little bit hope to invest in this area. Thank you.
You're so welcome. Thank you for having me.
Bye.
Alles Gesagte ist nur die persönliche Meinung von Julia Kistner und daher keine Anlageempfehlung und keine Rechts- und Steuerberatung. Für Verluste, die aufgrund von getroffenen Aussagen entstehen, übernimmt die Autorin Julia Kistner keine Haftung.